Hello, everyone, and welcome to the second webinar of this year from MSCI Carbon Markets. So today we'll be discussing biochar, one of perhaps the most highly valued carbon dioxide removal techniques. And because we are going to look at it from different angles today, our panel has team members with different expertise across our carbon markets team. First, today we're joined by the Managing Director of Carbon Markets, Jamie Saunders. Then we also joined by the CDR Product Lead, Gregor Mazar, as well as CDR Technical Expert, Konstantina Stamuli, who will explain to you the overview of this CDR carbon removal technique. Then we're going to dive into the integrity assessment of CDR and explore why it is considered to have such a high integrity credits. So we're joined today by our expert from Carbon Credit Integrity Team, Modi Cooper, as well as our Head of Carbon Projects and Integrity, Tristan Loeffler. And finally, we will discuss the outlook of the biochar credit market. So we're joined by our Head of Carbon Credit Forecasting, Ukash Akuri. As usual, our webinar will be recorded and will be uploaded to our website later this week. But you can take advantage of joining us live today by putting your question into the Q&A chat box, and we will try our best to answer them as much as we can at the end of the presentation. So I will now hand over to our Managing Director, Jamie Saunders, to give you an overview of MSCI Carbon Markets platform and how our product may be able to help you answer some of your CDR questions. So over to you, Jamie.
Yeah, thanks, Sam. Delighted to be here and see so many of you on the line. For those who are regular joiners and expecting to see our usual figurehead Guy Turner on the line, I'm afraid he's in the jungles of Costa Rica this week and sends his apologies. But you've got me instead for a very interesting agenda, as you can see here on the screen. We're going to kick off things with an introduction to the engineered CDR market at an overall level. And then we're going to dive deeper, as Anne said, into biochar, covering sort of what it is, what makes for a high integrity sort of biochar credit, what's happening in the market today, and how that market could look set to evolve in the coming years. And then we'll try and leave some time at the end for audience Q&A. But before we get into that, I think it's worth just spending a minute or two recapping who we are. I know we've got some first-time listeners today, and some of you won't have joined any of our events since we transitioned from being Trove Research to MSCI Carbon Markets. So all the team on the line actually today used to work at a startup called Trove Research, which was acquired by MSCI in November last year. MSCI is a large American financial data company, been around for almost 50 years. And operates all around the world. Its one of its best known businesses, its sort of legacy is in the production of financial market indexes, in particular equity market indexes. And among the 270,000 indexes it calculates every day are a whole host of ESG and climate indexes. And there are over $660 billion of institutional retail and exchange traded capital that's benchmarked against those indexes. It also has a well-established analytics and real assets business. And then most relevant for most of the audience today is it has a large and highly regarded ESG research business, of which includes the world's sort of leading ESG ratings provider and detailed sort of climate solutions, including now a carbon markets division. The carbon markets business aims to provide an extensive source of data, analytics, and research on corporate climate action more generally, and the use of carbon credits, structured around 6 different areas, each seeking to answer users' key questions, covering things such as how will new policies and guidance affect corporate climate action and their use of corporate credits, which companies have set climate targets and are using carbon credits today or in future, or will need to in future, what type of carbon credits are out there in the market, how many credits they've issued, we have a large dedicated team looking at the quality or integrity of those carbon credits, and you'll hear from some of that team today. We also spend a lot of time tracking the prices of those carbon credits to produce carbon credit price indexes and estimates. And finally, under Utkarsh, who's on the line today, we do detailed and quite sophisticated modeling in the short, medium, and long term for the market overall and different segments of the market. We have a CDR focused part of our platform, which covers all 6 of those different areas, which is led by Gregoire, who you're going to hear from in a minute. And yeah, just to give a quick overview of the CDR product, we do sell it on a standalone basis or as part of the overall subscription. And it covers, sort of looks at the CDR focused policy, tracking, email alerts, news updates, monthly reports, etc., understanding the fast changing policy landscape for CDR. We track corporate investments and purchases of CDR credits and model what future removals credit demand will be for each individual corporate based on their climate commitments. We track CDR projects with detailed profiles for each of those projects and look into the integrity of the registered carbon credits, which is largely biochar, and also have been in the process of developing ex-ante project assessments as well for CDR, which will be available on the platform soon. And then we track the prices and produce detailed sort of cost modeling for the development costs of CDR and forecast each individual sort of market. And you'll see an example of that from Utkarsh later in this session for biochar. So without further ado, I will hand over to Greg to take us through an introduction to the CDR market.
Thank you, Jamie. Hello, everyone. The focus of our presentation today is on biochar projects in the context of engineered carbon dioxide removal, the definition of which can be elusive, even for us who work in this market. So we define engineered CDR as the active removal of carbon dioxide emissions from the atmosphere, as opposed to avoidance or reduction using industrial processes, as opposed to natural carbon sinks like forest or ocean, without any other man-made assets. CDR is also typically defined through the lens of storage because emissions tend to be stored in underground geological formations. But of course, that's not really the case with biochar projects. So where do we start? The Intergovernmental Panel on Climate Change has stated that the world would overshoot its 1.5-degree climate warming target without the inclusion of removal technologies to deliver so-called negative emissions, with the need to be specific of 6 gigatons of CDR power removals per year on average, for a total of up to 660 gigatons by 2100. Governmental response has been very quick, spurred both by the IPCC modeling and corporate lobbying, with, in particular, the EU building on older legislation to improve definitions of removals and storage, the US, more than any other region, signing off on massive subsidy packages, and Asian and Middle Eastern countries focusing on public-private partnerships and cross-boundary storage agreements. Corporate climate commitment standards reflect the scientific imperative for large-scale removals in a net zero world. Both the Science-Based Targets Initiative, also acronym SBTI, and the ISO specify that only removals can be used to support a corporate's net zero claim. The SBTI's strong stance on the use of high permanence removals only in support of a net zero claim have in particular helped drive or increase corporate interest in CDR. However, we should note that most voluntary corporate standards allow the use of both removals and reduction credits on a company's path to net zero. One prominent example of such a standard is VCMI's claim code, under which just yesterday, Bain Consulting became the first firm to make a successful claim. SBTI is yet to publish its guidance on what actions corporates should take beyond their value chain while they transition to net zero, and the stance they take, if any, as to which corporates should prioritize investing in nation technologies like CDR in the near term, versus which should purchase more traditional reduction credits will likely have an important impact on the CDR market's growth trajectory. Besides new voluntary standards, government corporate claim regulation are starting to emerge, with California and the EU being two early movers. Laws and accompanying details are not yet finalized, but it seems that Europe may be leaning more towards a removals focus for offsetting claims, supported by its new Carbon Removal Certification Framework, or CRCF. A provisional deal was reached last week between the Parliament and the Council on this new removal certification scheme, so it is now highly likely to become law. It aims to provide an EU-wide standard for carbon removals and also soil-based emission reductions. And under the scheme, existing voluntary standards such as either CDR-centered registries like Puro Earth or the more quote-unquote traditional VCM registries like Vera or Gold Standard can apply for their own CDR methodologies to be recognized by the EU, although they do not have to. The CRCF defines 3 types of removal activities. 1, permanent carbon removals with a permanence of several centuries. 2, carbon storage in products, which must have a permanence of 35 or more years. And 3, more short-term carbon farming and soil carbon removals, which require a minimum permanence of 5 years. So for the time being, at least, carbon storage must be within the EU. And the resulting CRCF certified credits can only be used towards the EU's NDC and other climate targets. So while initially voluntary CRCF credits are likely to be required to make claims on residual emissions within the EU, now it's also possible that, as with other EU regulations, the EU standard becomes a global standard and starts being used by companies operating elsewhere. That being said, much of the details still need to be worked through, including what methodologies or standards will be accepted and how this is embedded within the EU's upcoming Corporate Claims Directive. So moving on from the policy aspect of CDR, the number of CDR technologies under development may be overwhelming to an onlooker, but they can be classified under a fairly small number of techniques. And this here is the classification that we use at MSCI. So while underlying transactions vary a lot in size depending on the technique involved, you can see that most pure tons of carbon dioxide equivalent sold in the past 3 years were from BECCS project or bioenergy carbon capture and storage, and DAC projects or direct air capture. As we'll see through the example of Biochar in this presentation, which accounts by far for the highest number of transactions, CDR differs both by its potential and in its present state from the rest of the voluntary carbon market. First of all, units are typically sold on an ex-ante basis, that is, on a forward basis as a pre-purchase or through a memorandum of understanding between a buyer and a seller, rather than on a spot basis, simply because a lot of projects are not actually operating yet. Second, they attract a specific type of buyer on average. These are typically tech firms, financial institutions, consultancies, or airlines, and they're all fairly tech-savvy. They also tend to buy through organized consortia such as Frontier or NextGen, which I'm sure a lot of you are familiar with already. And third, CDR issuances trade at a significantly higher price point than other carbon credits or units. The weighted average price of all CDR units sold in 2023, including Biochar, was at 265 USD against an average of $6 for reduction credits. So now we need to explore the drivers behind this price and why companies are willing to pay it, and I will let Tristan take it away.
Thanks, Greg. So as Greg said, a key question here is what is driving these high prices and this high willingness to pay for engineered CDR credits? And we fundamentally see 2 main categories of factors that are affecting this. The first of those is on the impact side. So buyers clearly want to maximize the environmental impact from their purchases and from their transactions. And we see a number of attractive features of engineered CDR to do this. Firstly, the fact that these projects do result in real removals, the fact that transactions at this early stage can catalytic effect by driving down technologies through the cost curve. And thirdly, that appeal of these solutions as a high-tech solution to achieve this. And these second sort of category of factors are much more on the integrity side. And engineered CDR is perceived by many as having higher integrity and fundamentally lower reputational risk than other project types that we see in the market. Particularly on the emissions impact side, across additionality, quantification, and permanence, these project types are seen as fundamentally higher integrity. And we'll dig into whether that's the case for biochar later in the webinar. So if this is the hype, I think it is worth reflecting on the fact that there are challenges with engineered CDR. And the first really starts with the fact that, at least in the very short term, the impact of these technologies is going to be somewhat limited. As the chart shows on the right-hand side, engineered CDR is starting from a very low base compared to biological removals or reduction technologies as well. And given the time required to scale production of this type of technology, even though the potential over 2050 horizon is very significant, this doesn't translate into material short-term impacts. So I think it's worth definitely reminding ourselves that these engineered removals will be an important part of the set of solutions necessary to reach net zero, but they're a necessary solution alongside other technologies such as reductions, which will have a higher impact in the short term. One reason for this limited impact in the short term is that the process of developing, scaling these technologies is both complex and expensive. Currently, the development costs of engineered CDR technologies are very high compared to the spectrum of reduction and biological removal technologies. And so those high prices that we saw these credits being transacted at are really necessary to firstly cover these costs and secondly provide that certainty and visibility and demand that will enable project developers and financiers to invest in the development and scaling of these projects. And lastly, it's important to note that while the integrity of these projects is perceived as very high, they're definitely not immune from integrity considerations. Particularly at an individual project level, we do see variability in the integrity of engineered CDR projects. And some of these factors we list on the right-hand side are common integrity considerations that we see for this type of category. So for example, the second bullet point here around the use of biomass, so engineered CDR products that rely on biomass as a input, clearly must appropriately consider what the alternative land use for that biomass would have been to avoid situations where maybe deforestation occurs to create biomass for these projects. The other point worth saying here is that the integrity considerations are not the same across all subtypes within engineered CDR. For a direct air capture project, the integrity considerations are going to look very different to a biochar project. And this is why we can't sort of just look at these categories altogether. We need to look at the project subtypes in a bit more specificity. And that's why for the rest of this webinar, we're going to really focus on biochar. And maybe some of you are asking sort of why biochar out of the different engineered CDR technologies. There are probably two reasons why this is the area we're focusing on. Firstly, it's the most proven and lowest cost technology out of the engineered CDR technologies we've seen. And secondly, in terms of its short-term potential, we do think biochar has the greatest short-term potential. And this is really illustrated by the number of registered projects that we see in the carbon markets. So for the remainder of the webinar, we're really going to be recapping what biochar is, diving deep into its integrity and discussing the market outlook of it. So to start with, what is biochar? Biochar is really the name for the carbon-rich charcoal-like substance that is the output from what's fundamentally a four-step process. And that process all starts with sourcing an input. And that input tends to be some kind of biomass feedstock. This could be forestry-based residue, it could be an agriculture residue, it could be a waste biomass. And once that input's been sourced, it will then be transported to some kind of processing facility in the second stage. And then once the biomass has reached that production site, what the key process then to sort of turn that input into biochar is this process that's typically called pyrolysis, where essentially the biomass is combusted in a oxygen-limited environment. And so once you have that output, which is the biochar, clearly the last stage is in terms of where it's stored or what the end use of it is. Typically, this is in soil applications for the majority of projects. And so thinking about this process, some of you might be wondering why this is a removal technology and where the removals are happening. And I think the easiest way to think about this is that naturally, clearly biomass that has been created would have naturally decayed, and as it naturally decays, it would emit CO2. But what this process of pyrolysis does is it means it locks in that carbon, and it then stores it in a way that it takes this carbon neutral process and turns it into a carbon negative one. So as I mentioned earlier, this is one of the more mature project subtypes within Engineered CDR. There are 39 registered projects currently. There are another 40 going through the registration process. To date, most of these projects have been registered under the Pure Earth registry, though we are starting to see more activity within both Verra and Gold Standard here. And I think geographically, it's quite an interesting picture where for biochar, most projects tend to be located in North America and Europe so far, though we are seeing some projects in pretty much every continent, particularly in the pipeline. So before we get into the insights on the integrity of biochar specifically, I think it's worth very quickly recapping on how we approach and define integrity at MSCI. And our integrity assessments provide consistent scores for over 5,000 projects across the voluntary carbon market. So we really pride ourselves on that comprehensive view of integrity. And all projects that we evaluate are evaluated against 6 main criteria that cover the emissions impact on the left-hand side and the implementation integrity that includes things like the co-benefits and legal and ethical risks. Beneath each of these criteria, there are clearly lots and lots of sub-criteria that are important to consider. But I think the main point I want to make on this slide is the fact that clearly the relevance of each of these sub-criteria and also how we assess them varies a lot by project type. And this is really why we develop project type specific methodologies that allow us to assess the integrity of projects based on what the key drivers of integrity are for that project type. And so if you look at biochar through this framework, when we've created our biochar methodology, there are around 20 key risk topics which we primarily focus on. And again, those topics really represent what are the most important drivers of quality for biochar projects. For example, just to pick out a couple of examples here, within additionality, given the fact that there are alternative revenue streams outside of carbon credits that can be available to biochar producers, understanding the percent of revenue that comes from carbon credits and how carbon credits alter the internal rate of return analysis is a really important consideration. While on co-benefits, examining the potential soil health benefits for projects where biochar is stored as a soil amendment is crucial. For those interested in learning more about our methodology, our detailed biochar methodology note can be found on the Carbon Markets platform. And actually last November, we released individual integrity assessments on all registered biochar projects. So the individual project scores and ratings can be found in our Carbon Markets platform for 34 registered biochar projects. And over the following slides, we'll provide some more aggregated insights into each of these criteria.
Perfect. Thank you, Tristan, for that. So specifically for additionality of biochar projects, we have considered a number of factors for our biochar additionality assessment, and the risk for each of these criteria has been evaluated individually. We have also taken into account more than 20 sub-criteria, including the technology maturity level, data for common practice, for all the project locations, and whether a project could qualify as a first of its kind in that region. Specifically, the potential of a project going forward without the use of carbon credits has been evaluated through financial additionality by assessing a number of metrics such as project costs, including biomass sourcing and supply, percentage of revenues from carbon credits versus alternative revenue streams, in combination with any existing financial support scheme, subsidies at a regional or national level. Projects that transparently disclose their financial information have access to limited alternative revenue streams combined with the first of its kind installation in that country, and at the same time can demonstrate that carbon credits were considered prior to the project start, are presented with low residual risk, resulting in higher integrity value. Overall, biochar projects, as showcased on the right-hand side, have good additionality characteristics with an average score of 3.6, which is higher than our overall project's average. Some of the key issues identified have been the lack of transparency on providing data for project costs and increased the risk that the project will be fully financially viable without the use of carbon credits in the near future. Going into a little bit more detail for one of the sub-criteria that we have looked, we have identified several alternative revenue streams for biochar projects and that we have identified, as you can see in the graph. This can range from like really high value, as you can see on the far left-hand side, which can be animal feed that command a market value up to $1,000 per ton, or on the far end, on the other side, you can be positioned in the lower end of the spectrum, which is construction materials or energy generation. It is important, though, to note that these streams are not necessarily mutually exclusive, and I'll explain a little bit further what that means. However, also not all of these alternatives are necessarily applicable to all markets and all projects, and they currently stand at varying levels of market maturity. What this means is that realistically, these streams might not be available for producers to sell their biochar products, as can be highlighted in the graph with different colors. So in red, you will see it's less likely, and orange are the more likely revenue streams to happen. Market maturity now is highly dependent on various factors. This can be insufficient demand, regulation, which is not at the level that we want, and the stage in the product development that the individual products are in. Our approach was to include all potential revenue streams relevant to the different biochar applications, assign an average value using independent sources and project data where project data was available, and then identify the level of market maturity for each of these revenues for the location that the projects were in. For example, a project that generates electricity and supplies biochar as a soil amendment can tap into two of those two revenue streams, both of which have medium market maturity and therefore could present a realistic and consistent revenue source for that project. Out of the 34 projects that we have assessed, nearly 80% are intended for soil applications, with the remaining split between construction, animal feed, and land remediation. Nearly 50% of the projects generate renewable energy, which is either sold or used for self-consumption in the process itself. Some of these revenue streams, like tipping fees, for example, are only applicable to waste biomass feedstocks and used only for specific applications. However, when tapped into those, they could significantly affect the financial profitability of a project. Emerging markets such as land remediation have also been considered in our approach. However, they are still at very early stages in the research phase, and they are presented, though, with a very high potential and could command potentially high market value. Moving into the carbon quantification approach and what we have looked, carbon quantification is central to the quality of those projects. And that is why we have included more than 75 data points spread between 15 sub-criteria in our method. We have assessed the quantification approaches employed by the projects to measure the carbon content of biochar. Those approaches could be just measuring carbon content, fixed carbon, hydrogen to carbon ratio, and a number of different other metrics, combined with the methods used to achieve that. For example, projects that use best practice scientific analysis and conduct rigorous biochar sampling methods to measure biochar's carbon content, lower the risk of overestimation. The other key assumptions analyzed include the biomass carbon content, and whether a project accurately accounts for all emission sources in all stages of the process. We have also tested the accuracy of those assumptions in the project documents on the biochar and biomass carbon content side using independent third-party data sources. What actually drives integrity higher is a combination of robust methods employed to quantify the carbon removal potential, combined with a strong correlation of the estimates against independent third-party data values. As you can see on the graph in the right, biochar projects score really high, 4.3 on the carbon quantification criteria, with limited risk and a high concentration of the projects around the 4.5 range, which sits above the average score of 3.1. Finally, projects that have transparently accounted for all emissions, including leakage, minimize the risk for overestimating the project's carbon removal capacity. In this slide, we have focused and included some of the key metrics used, such as carbon quantification approach and biomass carbon content accuracy. As shown in the graph, biochar can be produced from a number of different materials, starting from energy crops, forest residues, agricultural residues, all the way to municipal solid waste or waste streams. These materials and feedstocks have different carbon contents, and we have also, in our approach, we have looked at the project data, what the projects are saying in terms of carbon content, and used independent sources to validate those values and assess the risk with a subsequent overestimation potential. You can see the reference values, and then the project data are the bullet points. In general, we can see very good correlation between the project data and the reference value across all biomass types, with only a few projects exceeding the reference values. Projects that overstated the carbon content had a higher risk of overestimating the removal capacity, but such metrics have been incorporated in an approach, yielding reliable quantification results and thus strengthening the integrity profile of the biochar projects.
Thank you, Konstantina. Now I'll be taking you through the permanence portion of our methodology. Permanence is a really important topic for biochar right now, and I've seen some questions going around about it already, with many insightful papers coming out recently and some thought-provoking discussions had at the recent International Biochar Initiative Symposium, which has reignited the conversation. Here, we can see the spread of permanence scores for biochar on the right-hand side, which shows that in general, biochar projects score very highly, with the modal score between 4 and 4.5, which represents a low risk of reversal over the 100-year period. When compared with other carbon projects that involve carbon being stored in a carbon reservoir and therefore having some reversal risk, biochar has a relatively low risk of reversal due to its stability, particularly over the 100-year period, which is where most research has been conducted. Our own scoring evaluates that the best soil-based biochar projects, as over 80% of the projects are stored in a lower temperature soil environment, as this slows down the breakdown process, which we will elaborate on in one moment. The highest acclaimed method of determining permanence is the random reflectance method, an imaging technique used to determine the structure of the biochar, or using accurate carbon mineralization estimates, or the hydrogen to carbon ratio. This, coupled with reasonable duration assumptions, keeping closer to 100 rather than 1,000 years, and the utilization of a buffer percentage reduction, have the greatest permanence likelihood. Although no project scores particularly badly, as you can see, biochar applied to inappropriate end uses based on feedstock type and location have a higher permanence risk. This, coupled with no discount for leakage and an overestimated duration assumption with immaterial evidence, receive lower scores. Now we will focus in on projects where the biochar is stored as a soil amendment, which represents around 80% of the current carbon projects. Fundamentally, the risk of carbon loss depends on two factors: the type of process used to create the biochar, as shown on the vertical axis, and the soil temperature where the biochar is stored, which you can see along the top. As you can see on the right-hand side of the table, the permanence risk increases in higher soil temperatures and lower stability biochar, which is produced at lower pyrolysis temperatures. In the current group of carbon projects, 3/4 were applied in countries with average soil temperatures below 10 degrees Celsius, and therefore having a carbon loss of 20% or under in the 100-year timeframe that we have assessed, therefore having a high permanence likelihood. Many of the co-benefits of biochar also relate to its ability to improve the soil environment, as you'll see in the next slide. As you can see, The overall average score for biochar is greater than the average co-benefit score of other project types, but there is still a wide spread, going from 1.5 up to 4. In a soil amendment context, co-benefits should be listed, monitored, and quantified in order to improve their co-benefit integrity, ensuring that the biochar is reaching its full potential in application and that this is evidenced. This is bolstered further with evidence of economic benefits, for example, being given out locally and making an impact in local communities, or offering training or education in its application and potential use. Biochar also produces useful bioproducts which have the potential to make the whole process circular. For example, renewable energy, which can be reused in the pyrolysis process, or bio-oil and wood vinegar. Or projects may stipulate that they have used waste feedstock and described where this has come from and how far it has travelled and the emissions incurred from this. Projects score better if this is stated and proved. Projects fall into the higher risk category if they withhold information on their end use, so it is impossible to deduce what their benefits could be and how suitable the biochar is for that end use, based on its location and feedstock used. Biochar projects often don't elucidate on their social impacts, giving little information on benefiting the local economy or improving livelihoods, even though biochar has a great potential to do so. We would encourage extra transparency in project documentation in order to maximize integrity in this area. Scores can be mitigated through certifications, including using FSC-approved feedstock or having European biochar or World Biochar certification. Here, we can see the mapping of potential benefits for soil application. The size of these benefits primarily depends on soil type and region. Academic findings illustrate the potential scale of these benefits. Biochar can increase crop yields up to 50%, specifically in arid areas, and reduce the need for the addition of fertilizer. This all creates a lucrative increase in income from yield, with examples adding up to $2,000 per hectare. Although high soil temperature may reduce permanence potential, this does not necessarily correlate with soil co-benefit. For example, although Brazil has a higher mean soil temperature than average, as you can see here, the co-benefit potential is still very high due to the acidity and infertility of soils here. Biochar can increase the pH of the soil and fix nutrient retention. Biochar will have fewer co-benefits if added to already nutrient-rich, fertile soil, which you can see in and around Canada, when compared to adding it to arid land with acidic soils which face water scarcity and benefit from increased water retention, as shown in some regions of Australia. And I'll pass you back to Tristan to go through the rest of our integrity criteria.
Thanks, Mordy. So the fifth criteria we look at on carbon credit integrity is around legal and ethical risks. And these can fundamentally emanate from two main sources, the project developer or at the country level. And on both of these sources, biochar projects on average tend to have very low legal and ethical risks. So on the developer level, we screen all developers against sanctions, watch lists, and adverse media databases as part of our financial crime assessments. But very few biochar developers have identified risks against these. And secondly, given the fact that projects tend to take place in countries with relatively low corruption risk, risks at country level are relatively low. The last criteria is around delivery risk, and this is particularly important for biochar given how many transactions are occurring in early stage and a pre-issuance stage. And generally, when we look at delivery risk, we consider developer risk, so whether there are financial and execution risks that might mean the project doesn't successfully implement the project. We look at whether country risk could impact delivery, and we also look at natural risks. But for biochar, it's really the first two of these that are most relevant. So the financial and execution risks, for example, that might mean that a developer abandons a project or runs out of money to fully scale and reach production capacity. Given the technological complexity and high development costs of these projects, it's really crucial to assess these risks for ex-ante buyers. So for financial risks, understanding if projects have secured long-term revenue agreements in place or significant investment behind them that might provide sufficient cash flow to reach scalable production levels. Again, it will indicate lower risks, while on the execution side, a management team with a track record developing similar projects will have lower execution risks. So overall, now we've gone through each of the different integrity criteria, I think what we've hopefully shown is that existing biochar projects do have relatively low integrity risks. In fact, across the full spectrum of project types we've assessed as part of our integrity assessments, on average, biochar projects receive the highest integrity scores of all project types. And this is particularly driven by the high emissions impact integrity. However, it should also be noted that not all biochar projects are the same. We see high variability in integrity across biochar projects, which again shows the value of individual due diligence, even within lower risk categories like biochar. So hopefully we've convinced you of the potential benefits of biochar as a category. And I think a big question many of you might have is in terms of how the market for this is going to scale, and how far really biochar can go. And so for that, I'll hand over to Utkarsh to go through some of the market outlook.
Thanks, Tristan. I'm just going to start with the current market. So the voluntary carbon market has seen a sharp upswing in interest in biochar in the last few years. We've been tracking and analyzing issuances and retirements of biochar-based credits from all major registries. And so far, 2/3 of all biochar credits issued to date have come from projects in the US, although most credits issued in 2023 came from a single Brazilian project. Buyers of biochar credits have included some major corporates, including Microsoft, JP Morgan Chase, Swiss Re, and NASDAQ. From less than 1,000 tons in 2020, corporate use of voluntary credits from biochar projects has jumped to 34,000 tons in 2022 and 65,000 tons in 2023. On the price front, we see that over the last 2 years, the price of biochar credits have followed a consistent trend, with many credits sort of trading in the range of $100 to $200 per ton price. This is far above the $6 average we've seen in the voluntary carbon credits in 2023, although we have to keep in mind that the transaction sizes are typically much smaller for biochar credits. These high prices may reflect the permanence of biochar removal credits, in contrast to the biological or the nature-based removal credits such as afforestation and mangrove, which sort of lack that. How sustainable this price range is questionable, and is something we will sort of address shortly in the forecasting section. Before I move into discussing the insights from our forecasting, I would like to talk briefly about our approach to market forecast for CDR technologies. Our demand model includes estimating demand volume for various sectors and segments of the market, and then we estimate the willingness to pay for these credits, which is a very comprehensive exercise looking into a lot of details around corporates and companies that form the demand pool. On the supply side, we estimate the volume based on advanced geospatial and economic modeling of the project types, and then looking at the cost of developing these projects to produce these credits. I think the cost of developing these projects is an important input, and we've developed our own proprietary models to build out development cost outputs for all these project types. Price forecast then is sort of what we do is a scenario-based output and is a partial equilibrium solution to the demand and supply curves, and it calculates the market clearing price and volume transacted each year. So what we end up providing in our forecasting module is annual demand, supply, and price forecast up to 2050 for all these technologies. And beyond this, if you move forward, a key piece of modeling, as I mentioned, we do within our CDR product is estimating the levelized cost of producing carbon credits from a biochar operation in dollars per ton of CO2 sequestered. And this serves as a very important input to our supply forecast. And within this analysis, we look comprehensively into various capital and operational expenditures and the cost components while setting up or developing these projects. It is very important to highlight the variability in different cost components due to variability in project developers' approach and operational management choices can lead to a huge range of levelized cost at which biochar projects can be developed. The advantage from this analysis we found out is that biochar is much simpler and less costly operation than the other comparative high permanence carbon removal and storage technologies. key drivers of cost for developing biochar project includes input technology. I think one of my colleagues mentioned that the complexity of technology sort of challenges the scaling of biochar of the CDR projects. And while biochar projects could be built on fixed and mobile industrial units, which are slightly high technology and have a higher lifetime and include a mix of forestry and agricultural feedstocks, you also have soil pits and box kilns, which are slightly lower technology and considerably cheaper, have a shorter lifetime, and fully use agricultural feedstock. So the input technology which the developer is using sort of impacts the cost a lot. Then I think the infrastructure is also an important point, where you look at the biochar production equipment for carrying out the pyrolysis process, and also the transportation and equipment and site preparation cost is what sort of impacts the total cost of the project. And then I think we could see that biomass availability and feedstock cost are two major cost components which have a huge could have a huge impact in the long term for biochar projects. Now, when I'm talking about biomass availability, it's important to understand that the competing technologies such as sustainable aviation fuel or bioenergy carbon capture would also be requiring the same kind of feedstocks as biochar. So in the future, there is an expectation that there'll be a competition for feedstock, and the prices would sort of increase if the demand for all these technologies increase with time. So that would lead to a higher feedstock cost. Also, the type of feedstock you're using in the biochar production, as well as the sourcing of feedstock, play an important role in the overall cost of the project. Finally, I think community engagement is also something which is a sort of a feature of a carbon project rather than just a biochar project. But if the level of community engagement is high, it could be a costlier process. But then it helps the project achieve, I think, higher integrity and premium in the credit sale price. Currently, if you can see the chart on the left side, the cost of production stands at the mid to high range, but biochar we expect can be produced at a cheaper cost in the future as well. Recent standards have now opened the door to support more small-scale biochar projects in rural or less developed regions. The most recent update by the Vera methodology sort of distinguishes between low and high tech, and tries to accommodate for small-scale biochar projects. So there is a potential for increase in supply in the short run due to the development of more of these small-scale projects, and we'll discuss that more in the forecasting section as we move there. Right. For the forecasting section, what I'm going to do is discuss about the demand, supply, and pricing insights which our model has come up with. The approach would be that we look at the key drivers and what are the key figures in terms of growth in demand supply. We expect the demand to grow 15 to 25 times from the current potential by 2035. And the key drivers we expect this demand would be driving the sort of leading the demand would be number one, corporate targets and policies. As corporates move closer to their net zero targets and other voluntary commitments, the demand for high integrity VCM credits will ramp up, leading to a increase in demand for CDR and biochar credits as well. Additionally, we are already seeing removal-centric policies and mandates such as SBTI allowing only removal credits for the residual emissions, and EU sort of adopting world's first certification scheme to scale up removals. So all these policy signals are sort of positive in terms of increasing the demand of biochar. The emerging buyers profile is also one of the key leading points for increase in demand. Right now, we see that the corporate buyers currently inclined towards the removal market are mostly from big tech and financial services, but we do expect their peers to join in, and also other similar sectors to participate in the future. It's sort of enhancing the buyer profile for CDR credits. I think acceptability as high integrity option, as my integrity team colleagues pointed out about permanence and durability, as biochar's acceptance of a more permanence-based solution comes into play, I think the demand would sort of ramp up for them as well. If you then move on to the supply side, I think it's pretty clear that sustainable biomass availability would be a major factor which would impact how the supply scales up. Our assumption is that sort of our belief is that by 2035, again, overall the supply could grow from 18 to 27 times compared to the current supply potential if the price is around $100 per ton. But coming back to the drivers, I think sustainable biomass availability is a major factor. There will be competition for feedstock. So this could lead both ways. In the short term, you could have high availability of biomass and feedstock for building biochar projects. But as more and more technologies mature, there will be a competition and there will be a challenges to scaling more biochar operations because there's lack of feedstock available. I think that also ties up with the sensitivity to the feedstock cost. And one major, I think, defining factor for biochar is that it has a lower capital expenditure. So less investment is required to sort of build out more biochar projects, and it has shorter issuance time. So in the short time, you could start issuing more and more credits, and sort of increase the supply, ramp it up pretty quickly in the short term. And from there, if you move to the price forecast, what we feel is that supply from small scale projects and moderate demand growth could see prices softening in the short term. So there could be a likelihood of credit surplus because of these factors, but potentially there will be price strengthening in the long term, where you see competition between biomass-based mitigation pathways. The feedstock cost is increased, the cost of production sort of grows up, as well as there is growth in demand for biochar credits based on its integrity features, and there's a high growth in sort of willingness to pay for the corporates to meet their voluntary targets. So in the long term, you probably would expect the price to rise. But since our modeling is scenario based, I would also like to point out that there could be a low scenario which we consider, where we assume buyers shift their preferences in the removal credits to either more advanced technologies like bioenergy, carbon capture, and direct air capture, or continue just focus on nature-based removals, thereby decreasing the willingness to pay for your biochar projects. Additionally, it could be that low quality biochar credits are sort of accepted in the market, and because of their low cost of operations, they significantly flood the market with supply, causing the market surplus to stay longer than what we're expecting, and the prices sort of keep falling for a longer period. And with that, I would sort of finish the forecasting section. This is what MSCI Carbon Markets feels about the forecast, but we would be also interested to know what your view is about the market. And with this, I'll hand it over to Jamie to sort of run through the poll and its results.
Thanks, Akash and team. Very interesting stuff. As you say, it'll be, that's our view on where prices might go, but it'd be great to hear everyone else's view. So you should see pop up in front of you a request to fill in what you think the average price of a carbon biochar credit will be in 2025 and 2035. So if you could just select one of the multiple choice options there, we'll give it a minute or two, and then we should shortly see the results. So I don't know how we're doing on response rate. Do we want to close the survey? See the results. So hopefully everyone can see the results on screen there. So if we bear in mind that average biochar credit prices in the second half of last year are about $175 a ton. So we've got around, looks like around 60% of the audience, 65% of the audience think prices will come down from where they are today, and drop with almost 20% of you thinking prices in 2 years, the next year or two, will be below $100. So seems like a consensus that we're going to see falling prices over the next year or two, with relatively few, in fact only 3% seeing prices spiking up above the $250 mark, and only 8% above $200. So yeah, it seems like pretty strong market or webinar participant consensus there. And what about turning to the longer term, 2035? It's a more even picture, but there's still around 60% of the audience today thinking prices will drop below $150 and remain below $150. So looks like there's again a pretty strong view that prices are not going to spike up hugely above where they are today for at least another 10 years. We do see slightly more positive view for a price spike above $200 in the long run, with it looks like, what's that, 23% of webinar participants thinking that the price will be above $200 in 10 years time. So yeah, very interesting, and that's good. I think the wisdom of the crowd is always much wiser than even despite the clever brains we have here at MSCI. I think the wisdom of the crowd is quite indicative of where the market might go. So yeah, I think that leads us to sort of just saying what to look out for going forward now. So it's been a very sort of fast-moving, quick-moving market, lots happening in biochar space, and these are the sorts of things we're really looking out for over the next year or two. Will biochar prices start to fall below $150 a ton consistently? Is that the average we'll see in this year? Will the supply of credits spike above 100,000 or issuances above 100,000 tons this year? I think that will be a real benchmark level for issuances to break through this year. On the integrity side, I think key question is how the ICBCM with its core carbon principles, the CCPs, will look at CDR generally, but particularly biochar. Will that receive sort of the methodologies within the market today receive acceptance later this year from the ICBCM? And in particular, I think on the integrity side, one of the most interesting sort of more academic debates to follow is around the permanence. And that links to the EU carbon removal certification scheme that Gregoire mentioned at the start. Will biochar be considered permanent? Will it be accepted to have permanence of a couple of centuries, at least a couple of centuries? That will be important for how the extent to which biochar can be used and adopted for net zero claims in the long run in the EU. And I think the other thing that we're very interested to look out for MSCI is what the SBTI, the Science Based Target Initiative's beyond value chain mitigation guidance, which is long awaited, comes out with later this year, in what companies should be doing now beyond their value chains to help mitigate their impact on the climate. Will that come out with a strong leaning towards the CDR space, investing in the CDR space, or look more towards traditional credits, or be quite neutral in between the two of those? Will be interesting to see and potentially have a large impact on voluntary corporate climate action in the coming year or two. We're not only looking at the market over the next year or two, we're also doing a lot of work internally to try and continually enhance the insight we provide our clients, and there's lots more coming from us in the coming months. I think the subscribers to our platform can benefit from various enhancements we're adding in the coming couple of months. We're going to be releasing a detailed cost and market outlook report for BECS, and then later in the quarter for direct air capture as well. And we're also going to be releasing a Article 6 price forecast on how we think corresponding adjustments will impact carbon credit prices for our subscribers, and look at the potentially very large market that's developing around jurisdictional RED, and provide, particularly through financial services, new regulatory reporting solutions for carbon credits, and launching a new geospatial tool for cook stoves. We also have another webinar in just under a month's time on RED+, which anyone's welcome to join. I don't know if we can post the sign-up link, but you can certainly find it on our LinkedIn. It's going to be a really interesting topic. RED+, obviously, subject of a lot of debate in the market last year. We'll be sharing our views on what's next for RED+, and what the issues have been. So that'll be a really interesting one. And I see Am's just posted the sign-up link in the chat. So do sign up for that. And so to wrap up, I think we've taken a minute or two longer, a few minutes longer than we expected, but hopefully you found it interesting. We've probably got time for just one or two questions from the team as we run up against the hour mark. So maybe I will call up a question or two, shall I? I think we have quite a few questions around permanence. Maybe Constantina, you want to take this one as our sort of technical expert? I don't know if you want to talk more about whether we think biochar should be considered sort of permanent in inverted commas.
Perfect. Thanks, Jamie. Sure. Of course. Yeah, I think permanence is one of the most debatable areas in biochar, and that is because biochar kind of has a crossover. It's kind of like a semi-permanent material. So we do see a relatively low permanence risk over the 100-year time frame, particularly where the biochar is stored in lower temperature environments or is produced through a high temperature process, which ultimately results in a highly stably carbonized biochar. In reality, biochar is split into a very permanent fraction, which is the inertite fraction, and a degradable fraction, which means that depending on the conditions of the end application, part of the carbon will be lost and part of the carbon will remain stored long-term, which is what we have taken into account in our permanence risk assessment. Generally, we would expect some carbon loss beyond this 100-year time frame that we have considered. However, recent academic findings indicate that biochar in the 10,000-year time frame and beyond can still be very highly stable, nearly inertite. This subject is still like highly debated and constantly updated with new research. And it will be very interesting to see what position the EU takes on biochar, given they have tried viewing permanence on a couple of century time frame.
That's great. Thanks, Konstantina. Yeah, there's so many great questions here. It's hard to pull them out, but maybe to switch to one on the market outlook, Akash. You want to pick this one up? What do we see as the key near-term drivers for increasing demand for biochar and/or CDR, I suppose, more generally?
Thanks, Jamie. That's a good question. I think the key near-term drivers would be sort of corporate activity and guidance. I think that's most important. The voluntary corporate action we've seen it's gathering momentum by altruistic and profitable firms. And to take the demand to the next level, its requirement is that the promotion of CDR purchases within corporate climate standards sort of pick up. Second would probably be, I think, the government policies and subsidies. That helps to reduce cost. And as we discussed on the cost of operations for biochar, high-tech biochar projects require higher levelized costs. So government incentives, for example, in the US, probably after the elections could make a difference. Commitments by other markets as well, like the compliance markets in EU or UK or California, could also boost the demand in the long term. I think overall, the technology rate is also something which we should be focusing on. So as the technology matures for producing biochar, I think the cost sort of comes down to produce them, and that sort of makes cheaper credits available and drives sort of demand. And finally, I think minimizing delivery risk would be important. I feel a lot of these agreements right now are future offtakes, but it would be interesting to see how well this delivery is risk managed for these pilot projects. Delivery failures would sort of drag to stopping additional corporates from joining into the CDR segment. And finally, yeah, from delivery risk, I think linked is transparency as well. All CDR projects are currently thought of have a high integrity, but they're not free from integrity risks. So delivery risk and integrity risk, both of them would be important to sort of deal with to ensure that there's short-term demand.
Great, thanks, Akash. Probably got time for one more question for those who want to hang around on the line. So maybe Tristan, you want to take this one? I've seen a few questions in the chat around alternative revenue streams for biochar and how much sort of financial additionality needs to be considered in the removal space, and how might that evolve over time? I don't know if you want to tackle that question.
Yeah, thanks. It's a really good question, because I think, as one of the slides Konstantina showed, given the potential prices of some of these alternative revenue streams and the cost that Akash showed, it's theoretically possible to create a profitable biochar project without carbon credits. But practically at the moment, given the maturity of these alternative revenue streams and fundamentally they're not available to all developers, it's very difficult to think about how alternative revenue streams are sufficient without carbon credits for these projects to go ahead. So I think that question is an interesting one going forwards. If some of these alternative revenue streams become more mature, then could this create more additionality risk for biochar? And I think that's definitely something we're interested in sort of keeping a close eye on.
Yeah, indeed. Thank you, Tristan, and thank you to all the team. I think we should probably wrap up here, Ram, given we're over 3 minutes past. So yeah, I mean, lots of great questions. Sorry we couldn't answer them all. We never have time to. But yeah, I think if you've liked what you've heard and you'll be interested in learning more about a subscription, please do get in touch. And yeah, do follow us if you'd like to hear more on future webinars. And thanks for all joining us, and have a good afternoon.